Hello. Welcome, Maverick traders, to targeted butterfly spreads. I think I'm going to turn some things on its head a little bit in terms of how you think about butterflies traditionally. I'm going to emphasize some of the key points. I trade butterflies differently than a lot of, I've kind of created my own approach to them. So we'll see if you like it, think it makes sense. You can practice trade it, just kind of work with that throughout your trading plan. When you think of a traditional butterfly, here's what you get. So this is just a basic call butterfly breakdown at 95, 100, 105, and let's assume that the stock is around 100 per share. Traditional butterfly would be a neutral trade. And so usually when you tell people that, oh, I'm going to trade a butterfly, they think neutral. Oh, sideways, you've got this little spread and you're expecting it to kind of stay in that range. And if it stays in that range, this is your profit diagram, right? If it looks like your break evens here are maybe 97 per share and 103 per share. So if it stays between 97 to 103 at expiration, we're going to make money. If it's outside of that, clearly if it's below 95 or above 105, well, that's where you're going to end up at losses. And that's true. I mean, we're still going to create a risk graph like this one, but we're not going to do it neutral. With a targeted butterfly, in trading, it's often like real estate: location, location, location. The location of your trade dictates so many different things. See, if I were to tell someone in a butterfly, you're actually trading two spreads, right? You're trading a bull call plus a bear call in this trade if you're doing a call butterfly. If you were doing a put butterfly, then it'd be a bear put and a bull put combined together. But in this particular trade, any butterfly, it's two vertical spreads connected. That's what we have. We have a 95-100 bull call spread, plus we're short another of the 100 and long the 105 in the bear call spread. So you're bullish on this side of the risk graph and you're bearish on that side of the risk graph. And what it does is it creates, this debit is knocked down by this amount of credit, and it creates a lower cost, kind of a neutralized trade. You don't want to be too low in price. You don't want to be too high in price. If it gets outside of that, either too far that way or too far that way, you end up in a losing proposition. But if we really think about spread trading, in simplify, if I trade a $5 vertical spread, what am I really doing? Well, I'm trading something that goes anywhere from $0 to $5. That's all it is its minimum. What could happen is it goes to 0, and that means the trade expires worthless, or it could go to max value, right? Which, if I'm trading a $5 vertical spread, the most that trade could ever trade to is $5. That's it. So when we're trading this $5 vertical spread, we're buying it somewhere in the spectrum between 0 to 5. And if we pay $2, well, we got 2 of risk and 5 of reward. If we were to pay $3 for the trade, well, then we have 3 at risk and 2 of reward. If we were to pay $4 for the trade, well, we've got $4 at risk and $1 of reward. It's always going to be quoted somewhere between its minimum and its maximum value. A butterfly spread works the same way. This is a $5 wide butterfly spread. So it will always trade somewhere between 0 to $5 in value. If we did a $10 wide butterfly, if this was a 100, 110, 120 call or put butterfly, then it would always trade somewhere between 0 to $10. 0 being its minimum value, 10 being its max. And if it was quoted at $3, well, then that's where it's trading between 0 to 10. It could grow to 10 or it could fall to 0 in value. If it's a $5 wide, hey, if it's going for 2, it could go to 0, it could go to 5. That's its. So it's always trading somewhere in the spectrum between minimum and maximum value. Now, if I pull up, let's go pull up an Interactive Brokers platform, and let's screw around with some things here. Let's use Apple. Apple's a good example of what I like in a butterfly. First, it's a higher price point. Stock's at 136. Why do I like high price stocks? I don't really trade butterflies on a $20 or $30 stock. The reason is your expenses will be huge if you do. You know, think about it from the standpoint of, watch this. Let's just build a $10. Let's do it a little wider. Let's do a $20 wide butterfly. Now, I'm not so worried about what this butterfly is. I'm just throwing out numbers, okay? We'll get into a more specific example here in a bit. Let's do a $20 wide butterfly. Let me just show you what I mean here. So here I just build a 110, 130, 150 butterfly. So this trade is going to go for anywhere between 0 to 20 in value. See, it's 20 points wide, right? 110 to 130, 130 to 1. It's a $20 wide butterfly, and look at where it's quoted. It's quoted at about 10 bucks. So it's trading, it's a 50-50, 1-to-1 reward to risk ratio. We can buy it for about 10, and it could grow as high as 20, or it could fall as low as 0. So it's going to trade in the spectrum. It's a $20 wide butterfly. It's going to trade anywhere from 0 to 20, and right now it's right at about 10 bucks. Now, why do I like trading a butter? First of all, that's an expensive, and I don't trade 1-to-1s, and I don't trade them really neutral. So this is not what a targeted butterfly is, but I want to build some understanding of things first. Why do I not go trade some butterfly on Pinterest at 20 bucks? Well, here's why. Stock's at 18 bucks a share. Let's again do kind of a neutral butterfly. And since it's a fraction of the stock price, let's do a $2 wide, which would be very similar in terms of percentages and whatnot. So watch this. Instead of, like, this one butterfly would cost me $1,000. Most of the butterfly, I'll show you with Apple, we'll probably build one that'll end up being like 300 bucks at risk or something. But look at the difference. If I was to trade, these are very similar structured. I've got $20 distance on a $100 stock, or I've got $2 distance on a $20 stock. Percentage-wise, that's very similar. This butterfly only comes out to like 45 cents of cost if I split the bid-ask spread. What's the problem? If I was willing to risk $1,000, I trade one contract of this trade, and my commission cost is negligible. It's 4 legs times, 65 cents a contract roughly. I've paid $2.60 in commissions to trade this butterfly. I could trade, if I was willing to buy this one and spend $1,000, and each one costs $45 a piece, $1,000 at risk divided by 45 bucks per butterfly, I can trade 22 contracts. Well, for heck's sakes, my expenses are through the roof now because I'm trading 22 contracts of a 4-leg spread. Now I've got 88 contracts. If my commission is roughly 65 cents a contract, now I'm at $57 in commissions versus up here I was at like $2. Now, that might not sound like much, but I personally, for basically the same opportunity, why would I spend $55 extra in expenses? By trading a low price point and racking up huge contract size, I didn't get any benefit, but I added a huge expense. So I personally don't like trading low stock prices. In fact, most of my stocks, I look for hundreds, 300, 400. I mean, I want high stock prices for the things that I trade. I also want liquidity. That's a huge factor. Huge factor. Both of these are probably doable. There's a stock that I highlighted on the bearish side a couple of weeks ago, but I emphasize this point. Like, you almost can't trade this as anything like a butterfly or condor or anything. It's MSTR. Why? It just doesn't have the liquidity. Look, by the time they call it the spread of the spread. So if you look at the options on a stock like this, if I tried to do some sort of butterfly, I'm trading, I mean, let's do some call butterfly in MSTR and look at how wide the spread of the spread is. Watch this. So MSTR is at 100 and what's it at? 170 bucks per share. So let's build a $20 wide butterfly and compare it to Apple. And you'll see the spread of the spread is just gigantic. It's a complete ripoff to try to trade it. You'll get, if you do get an execution, it'll be because you sacrificed price, and it's just terrible. Look at this quote on this call $20 wide call butterfly. 0 bid, 740 ask. Where does that come from? Well, there's $3 distance on that. There's $2 here. There's a $1.30 there. You add all those up. That's called the spread of the spread. The distance between buyers and sellers is just gigantic. It's enormous. And we're traders. We need liquidity. We need to be able to get executions. If I sat here all day and tried to get filled on this, I would never get filled. Or if I did, it'd be because I paid such a bad price to do it that I'm already at a huge disadvantage. So no thank you. If you don't see these bid-ask spreads fairly close together and ample liquidity, if in doubt, throw it out. I mean, I want high liquidity stocks for anything like butterflies, multi-leg combo trades. If you're gonna trade MSTR or something with less liquidity, you pretty much have to do a single option. You just have to like buy a call or buy a put or some, and even then you're still dealing with liquidity problems, but it's, I guess, more doable than trying to get filled on some butterfly with 3 legs that all have liquidity problems. So avoid low stock prices. That's something I do. Whoops. Avoiding low stock prices, that's something that I do. Avoiding low liquidity stocks and only trading, butterflies, targeted butterflies like we're going to talk about on high liquidity names. That's also something I do. I am not a fan of these one-to-one type of reward to risk neutral butterflies. It's a lot of risk, and I just find it kind of not advantageous. The idea that the stock is here at this price, and so I'm going to bet that it stays here, is sort of a bad bet in that the stock's going to move. So at best, it's going to move away from where you want it to go, but hopefully it comes back. If I put on a neutral butterfly, I'm literally guaranteed to sort of move away, but hopefully it comes back quickly and I'll have some profit. Neutral butterflies are tough for that reason, because when you pull up a stock chart, how often do you just see it flatlining? How often is it just a perfect flat line, where it's just today, tomorrow, the next day, it just perfectly went sideways? You'll see it for a couple of days, certainly, intermittently, but for the most part, we're kind of progressing. So if you had put on a neutral butterfly here and it went away, well, you're hoping it comes back. Now, it might do that, but I could also just target areas. I could say, well, I'm targeting this to go towards here over time or to go towards here. And by doing that, I'm putting on what the market feels is a lower probability trade. Because the market says the stock is more likely, think of it as the 2/3 versus 1/3. The market looks at it as up, sideways, or down. This is kind of how the market thinks of it. And if I put on a neutral butterfly, then I profit from the sideways move. They give me a worse risk to reward because they say, well, it could easily stay sideways. If I bet on it just making the big move up, now I lose if it just stays sideways for a long time or goes down. So I lose in a couple of ways. I only make in one. Or if I bet on it going down, I lose on the sideways, I lose on the up, but I make if it goes down. Well, that's the other reason that I don't do these short term. I'm putting on a trade that's implying that I'm going to lose 2/3 of the time and only get it right 1/3 of the time in a targeted butterfly, because I'm putting it on. All of my legs are out of the money. The whole butterfly, the whole location of it is away from the current stock price. It's implying that I have a low probability of success. Well, here's the thing. You've heard me say this before. I'm a believer that it's easier for me to know what's going to happen than when it's going to happen. The precise timing of the markets, the idea that I can figure out, that's why I don't day trade and stuff, and why day traders have such bad success rates is it's just hard. It's just difficult to try to pinpoint every little turn, and nearly impossible. But if I understand the markets and I understand what's happening, it's much easier for me to kind of see the progression and kind of say, okay, I don't know exactly when it's going to happen, but I've got a pretty good sense that it's heading here or that it's going towards here. I've seen this play out before, and I won't get all of them right, but my reward to risk is going to be exceptional. And if I'm pretty good in the markets, I can get most of them right, right? Like not all of them, but I can get a lot of them right and have a really nice risk to reward because of that. But I've got to give myself time. Again, a little weird. Most people, when they trade butterflies, they do really short term because they're trading neutral and they're like, well, I gotta hurry and have this thing expire right here in the middle. Not me. I trade multiple months out here. It's more about the progression of where I think something's going and how I think it's going to play out. And I talk about this. I mean, I'm more of a little bit longer dated trader than most of our traditional traders, that are highlighting trades, the Maverick guys. They might highlight some couple of week trades. You could do a vertical or a diagonal. I trade, I would say the majority of my trades are a couple of months in duration. If I'm in July, early July, I might be putting on trades that have a September expiration and so forth. October even, where I'm looking at the progression of things and where things could go over time. So I mentioned this. Let's do a market update since we're going to highlight some concepts here. Here's SPY. Now, I said this in the market roundup on Tuesday. You're in one of two camps. Either A, you think it's away we go to the downside, right? Bon voyage. See you later. And we're going to break the lows, and this is a bear market, and we're about to collapse. Or you're in camp B, which is where I find myself, which is I suggested I think we'll get another drop here, and that'll be a buying opportunity. I think there's another wave coming, and markets were down today. I think we're bouncing. Well, we're this we're starting to bounce, but even before we started to bounce, this is it. This is what we were talking about. I think we establish a higher low here and progress to the upside. Now, I don't know how good it's going to be, but I think we can make another leg, another wave to the upside, a pretty good sized move. So for the highlight today, I'm going to put on a targeted call butterfly, just kind of given my market outlook for a rally. And then next, we could talk about candidates. I highlighted a few. You could look at Merck, which is kind of in this cup and handle. You see the cup and handle formation for a potential breakout. And 100 is a big psychological zone. Alibaba kind of looks interesting. It has this little cup and handle, ascending triangle, probably should break out to the upside. And then we highlighted ABV as a potential candidate. And ABV has a little pullback here and potential for further upside. And I'm going to use ABV as the example today. So now we've got to think about, well, what are our potential targets? Where do we think this thing can go? And part of this is technical from the charts. You might look at identifying some key levels. Obviously up here is the resistance. I mean, all the way up at the highs of 174. I think one in the 160s is kind of next stop up there, mid 160s and whatnot, just on a charting perspective is where we should be progressing in the coming weeks. But it's also about the volatility in the markets and getting a sense of where this stock is likely to go based on probabilities. If I come into ABV, there's a couple of ways I can do this. I could go here in the Analyze tab and go out in time. I want to go out a couple of months and kind of see, well, where does it say probability wise? I could put these slices to just one standard deviation, see that 68% range, and basically say, well, where do I think this thing can be? It's here. If it's bullish, it can get up in here and as high as 171. If it's bearish, it goes down here and as low as 131. But that's the probability range. There's a 2/3 chance it'll be between here. The reason I want to look at that and kind of get a sense of, well, where can it be? There's a couple of ways you can do that. You can take the at the money straddle value for September expiration, and it'll build much the same type of diagram. We teach that in the targeted butterflies class. But basically, I want to know if my targets up here in the 160s, 170 range is even doable. If, for example, I go back to August, you'll notice that targeting 170 now isn't real doable, meaning it's outside of the probability range. It's telling you the probability of getting to 170, it's just not likely. About as good as it could get is 167 based on probabilities. Now that there's no guarantee, maybe it's extremely bullish, but I do like to have enough time and have my target where I build the body of the butterfly be inside of the shaded area, be inside of the probability range, or kind of on the, at least kind of on the edge of it. I don't want it to be way out here normally. I'm not speculating so much where I'm putting on a trade that just has low chance, low probability of ever getting there. So it wouldn't really make sense to me to be building some butterfly targeting 180 through September because the market's telling me, there's just not much chance. I mean, in fact, if I grab this and put it over here, it says there's an 8% chance. Well, that means there's a 92% chance it won't happen, right? So I want to be in this shaded area as far as my target. Now remember, my butterfly is probably going to be fully out of the money. I mean, every leg is probably out of the money to start. That's going to create a few different things for me. One, it's going to create a great risk to reward, but two, it's going to imply a low probability, right, of success. So my whole butterfly is going to be constructed up here and probably out of the money. So what does that look like? Well, stocks at 152, couple of key points. Notice that I'm dealing with high stock prices. The stocks that I highlighted for bullish trades were, ABV and Baba and these high price points. Those are the stocks I like to trade, first of all. I want to cut down on expenses. Second, I want liquidity. This one has good enough liquidity. So let's go even to the September options, a couple of months out in time. If I start to look at the bid-ask spreads, they're close enough together that it's doable, that it's manageable, right? And I want to create a really wide spread. I want to have a big area. I don't want a really teeny tiny butterfly. So this stock's at 150 per share. A good rule of thumb is create your butterfly at least about 10% of the stock's value in width. So if the stock's at 150, I need at least 15 points between my strikes. I need to create at least a $15 wide, which is 10% of the stock's price, wide butterfly. And I might even go more than that. I might go 20 points width, but I want it to be a wide area. That's going to create a better success probability. So let's just look at this. The stock's at 152.80. 170-ish was kind of our target. We could probably build a 15-point wide butterfly. So let's go buy butterfly. I'll take this down to a simple 1. And we're probably going to be at something like a 155, 170, 185. And there's not a 185 strike even available. So that's a problem. Okay, so let's nuke that. Do we have all strikes? They only go to 175. I'm kind of surprised by that. Well, you can see we're doing this together. I could go out a little further. There's a big jump. There's not an October. So we could go wider that way. Or how high did that strike go in September? 175. It's just not going to be doable. It's not going to be doable in September. We don't have enough strikes up there. That happens from time to time. You can see we're going on the fly. We're doing this live. Let's give ourselves even more time. Now, there's some trade-offs to going to more time. One, we'll have more potential for this to go into our zone. We're giving it more time to be right. But number two, there is a negative in that now you got to sit on this trade more to make more money. Because in a butterfly, there's two things that you're trying to get right. You're trying to get the price right, but you're also trying to get the timing somewhat right. Meaning, the closer you can get to the expiration and have it in your zone, the more money you make. In other words, if this stock flashes up into our butterfly zone and surges to where we want it to go, but it happens early, happens in August, we're not going to make as much as if it did that later or closer to expiration. I'll show you that progression here in a bit. Again, 170 is our target. Let's build that 155, 170, 185 spread. Okay, so we're going to buy the 155, sell the 170, buy the 185, just a standard 15-point wide butterfly. And look at this. It only costs $287. You see how I said, look, our butterfly is not going to cost us $1,000. You wanted to put on that neutral trade in Apple. You're going to risk $1,000 to try to make $1,000. Here, we're risking, let's keep it a simple number, call it about $300. We're risking $300. It's a $15 wide butterfly, so we have $1,200 of potential reward. Watch. If I hit the Analyze button and take a look at this, let's go out this way like that. So look at what happens here. $300 is your max risk. See that right here. Max losses at expiration, 300. If it's A, too low in price, or you'll see it'll flat right over here. We're still at negative 300. Look at that box. Negative 300 if it's too high in price. But look at how wide we've cast this net. We have a profit zone that's pretty wide here. And it grows all the way up. See, we're up 300, 400, 500, 600, 700. It'll go all the way to $1,200. And then it'll start to fall off from 1,200 back to 1,100, 1,000, 900. We can make upwards of 1,200 being the max. But you could land anywhere in here. You can make 600, 800, 900, 400, 200, depending on where you're at inside of the zone. But you look at this, and it's a big, wide net, right? It's a big, wide area. If I set these slices to break even at expiration, you can see that we've got a profit zone between 158 to 182 per share. That's not too bad when you really think of it in terms of probability. $24 wide on $150 stock, you're still talking about, on a percentage basis, a pretty good area, pretty good window. Now, here's what I was talking about. They'll give you a little probability number, and they'll say, well, the odds that you're going to land in there is only 28, 29-ish%. So that implies there's about a 60, well, I'll call it 71% chance that you're going to lose, is what that implies. And most of that probability is that the stock's too low. Why? Very little chance you're going to overshoot up here, but high probability you're going to be too low. Well, why? Because the stock's already down here. They're saying good chance it stays neutral, or if it's bearish at all, you got a problem, right? But you're only risking $300 if it's neutral to bearish, if it flashes at any point in time. Now, if it flashes early, you won't have as much profit. Let's just skip forward a month or so. You're profitable. It's moving into your zone, but see how you got to waste more time. We were looking for September, but the more time you waste and it's in your zone, the better. So this is a trade that, for max payoff, you have to sit in the trade for a while. You have to kind of hunker down. Now, I don't always stay in all the way to expiration. I would kind of look at it as, imagine it's right here where I want it to be, and we're in early November. I might kind of look at it as, well, I'll take half of my butterflies off. I'll take profits on half and maybe ride the other half of my contracts to expiration, right? So if I bought 10 of these butterfly spreads, I might sell 5 and hold 5 or something like that, because it's there early. And what do I know? Well, I know it's going to move. I know for sure the stock's going to move on a day-to-day basis. So best case, it moves away and then hopefully it comes back again. And I'll have more profit if it does, right? If I waste more time, yeah, that profit will keep jumping, but I need to keep getting back there. And it just has too much chance of going away. So sometimes, the nice thing about these targeted butterflies is, again, you don't have to stay in all the way to expiration. Heck, here you're up $640. You only paid $300 for the trade. You've made a 200+% return. So you could get out early at a big profit. Now, this one's quite a ways out there because we had to go to November. Let's do one of the other examples. Let's say Baba, okay? So again, I would go through this and kind of say, okay, let's break it down piece by piece. Look at the chart. Let's set a game plan. Let's think about where this stock is going. Maybe I want to target a butterfly up here to the gap zone, 150, 160-ish. Stock's only at 114. That's a big target. But remember, we're giving ourselves multiple months. And so maybe I think we could get up there towards 150. This is how I do it. These are, the same way that you could have targeted different things. Like, I put on some trades to target different levels, by the way, in Baba back here, and look at how it dropped down. If you were trading some targeted downside trades, they could have had huge payoffs with great reward. So let's say with Baba, let's go out 2 months and see where this stock can be. Let's bring this back to today. And what does it say? Well, it says, okay, between now and September, let's set the slices to the one standard deviation. It says, okay, here's where the stock is at. If it's really bad for this stock, it's going to go down towards, 80-ish. If it's really good, it's going to head up towards 150. There's a 68% chance you're going to be somewhere in that range. So a targeted bullish trade would probably be up here between now and September. And a big targeted bearish trade would probably be positioned down here. And you have to, the nice thing about these is, again, big payoff. but you have to believe that the stock's going to make a big move. If you're really neutral and you just think the stock's going to languish and just kind of be choppy and sideways and so forth, well, then this is not a great strategy for that environment. You know, if it's just going to be quiet, low volatility, sideways movement, move on to some other strategy. When you think a stock can make a directional move and you're not real precise on the short-term timing, but you think it's going to keep working its way towards an area, well, then you can target that. So let's go build a little shorter term, not quite so far out in time. As we look at Alibaba, so we could go to September and explore, and we were kind of thinking 150, and that's in that probability range. Stock's at 114. I could trade a $20 wide spread. Let's see what one looks like. And I might even go a little more conservative. Let's go to 145. Let's see what that, we won't build it quite as aggressively. Let's go let's see, 125, 145, 165. And you'll notice just a really nice risk to reward. Okay, we're paying $260 for a 20 wide spread. Check this out. So our max risk, now we can lose, see the $262 losses. If it's low in price, so if the stock stays here, this is where it's at. If it stays here and just, or it goes lower, you're going to lose $262. And oh, by the way, if you want to know probability of that happening, they say the probability of you taking a loss on this side is about 69%. So that's the nature of, you're not getting the benefit of a neutral move. They're going to give you 2/3 of the time. They're going to imply you're going to lose, right? Because you're going to lose to the neutral and you're going to lose to the bearish move. But you're going to make on the bullish, and the payoff is quite nice. Now, the problem with the butterfly is the overshoot. You do have risk of the overshoot, but that's why this trade costs so little and it has such a big payoff. Because you traded a $20 butterfly, remember your diagram. So in this case of Alibaba, with the stock at 114 per share, we're trading a $20 wide butterfly. That means here's our diagram. It could go to 0. It could go as high as $20 in value, and we're paying $2.62. So our trade could tip this way and go to 250, 240, 230, $1, 80 cents, 70 cents, 0, right? It could tip this way, and that's your risk. $2.62, $262. But it could tip this way, and it could grow as high as to $20 in value. That's where that risk to reward comes from. That's why you have, in this case, you'll see on that risk graph, our max reward would be 17, I do that in my head, 1738. It would be 1738 of potential reward. Why? Because you're paying $262 for this trade, and it can grow to 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. It'll never trade above 20 in value, but that's its max potential value. It's a $20 wide spread. So it could trade up to 20 or it could trade down to 0, and you're buying it when it's right here on the spectrum. So you have a big reward, low risk breakdown. And that's what this risk graph shows. But as we look at this, here's where it's likely to be. It's still in the shaded area, right? We're still in the shaded area of probability, but we're on the right edge of it. We're on the bullish side. And that's where I want my targeted butterfly to be if I'm bullish. And if I were bearish, it would have a big TP over here, right? Big payoff if we make the bearish move. I lose to the neutral, I lose to the wrong direction, I make to the right one. Let's do a hypothetical on a bearish side, just to give an example. Let's just throw up a market. Let's just say we were going to bet on the Qs or something. It's at 281. It really doesn't matter. I'm just going to do an example here. Let's say, where could the Qs be between now and October? Well, they could be between about 337 to the bullish move. 281 is where we're at now. That's the neutral. 224 to the bearish. So if we were bearish, you could build some trade out in October down here, right? Down at the 230-ish level is kind of where you'd butterfly that. Stock's at 281. Okay, let's nuke that. Let's go out to October. And again, now we go to the put side because we're bearish. We're going to create this targeted butterfly using the puts. All of the legs are usually out of the money. And we were saying, what was our area? Down to about 230. So if you wanted a trade out there, you probably go, the stock's almost 300, so we would need a $30 wide butterfly probably. So I'm going to buy a butterfly, and 230 was our target price. So we'll go 200 underneath and 260 up above. $30 width. Why 30? Because that's about 10% of the stock's price, right? It's 10% of the stock's value in the width. High price point, only $300 at risk for a $30 wide spread. What does that give us? Well, it gives us a huge risk to reward. We can lose 319. We could make up to $30 is the width minus 319. So 20, again, can I do that in my head? 2681. 2,681 is your max reward. So 2,600 reward, $300 at risk. Now, here's the thing. Let me say something about the risk management, trade management of this. I almost hate talking about the max reward because the max reward's not going to happen. Let me just slap you in the face right now, wake you up and say, you are not going to land it perfect on the perfect day at the perfect time and make that peak profitability. Let's just have a reality check here. That's not going to happen because if you get there early, you're not going to be at max profit. You'll be profitable, right? It'll keep building. But if you get there a month early, you're up 570. Yeah, I mean, that's a great return. It's almost 200% return, but you're not at a $2,600 profit. You're at a $570 profit, being there a couple of months early. Or if you get there 1 month early, again, now you're up 800. But you're not up 2,600. Okay. Now, if you were to land there perfect at October, you got lucky as all get out. But it's just not going to happen. And it's not really the way that I trade these. So let me give a reality check of sometimes people trade these and they set it and forget it type of management. That's not my style really. I'll do that with some of my contracts perhaps. I'll take off, lock in some profits, and then maybe do some, hey, with these, I've got profit in my pocket. Worst case, they end up at a loss. Maybe I'll see if I can, just leave these to expiration. But for me, it's not about even trying to make the 2,600. That'd be nice, but that's a pipe dream. It's more about the risk to reward of, I'm only risking $300, and if we flash into this zone as expected between now and that time period, I'm going to have a big profit. And I might take this thing off when I've locked in $700 a profit or $400 a profit or $1,100 a profit because we're at my target. We're too early, but we're at my target, and I know it's frankly just not going to perfectly flatline there. So do I think it can go away and then come back? If I'm really confident that's going to happen, I'll stick with it. But otherwise, I'm probably going to take my money and run. Okay. I'm going to reward myself for being right about the outlook of the trade. The timing, what did I say from the start? The timing's the hardest part, and the timing is what it's so difficult to get right and precise and so on, and you just can't do it. So I don't need to get it right on the perfect date. I need it to go towards 230, and if it happens sometime between now and October, I'm going to have a nice big profit. I can lock that in, put it in my pocket, and move on to the next opportunity. So the management of this is not necessarily hold to expiration. When it's it's a long ways from your target right now. When it gets to your target, some time will have evaporated, some profit will be there, and you certainly need to think about locking in at least some of your contract's gains. So that's some aspects of the targeted butterfly that kind of make sense in terms of things to think about. High stock prices, high levels of liquidity, really wide spread. And by creating all of them out of the money, you're still within the probability zone of where this thing can be between now and an October expiration and so forth, where it's likely to end up. But nicely, I don't know why this is, oh, it's probably because I have this date off. It's throwing, so there we go. See how it's inside of the probability range, but on this edge of it, it still has a big, I've cast a wide net area here. It's just that I lose to the neutral or I lose to the bullish move. So I lose 2/3 directions I make on my 1/3. Well, that's this kind of, that's why you get this great risk to reward is the market saying, well, you're putting on a trade that's got a low implied probability according to the markets and how it's priced, but not according to how good I am. If I can really get a sense of where things can move towards over time and get a lot of these right, not to pat myself on the back too much, but trade them really successfully. So anyway, that is a little bit more about the targeted butterfly spread, some of the concepts and approaches and things to think about. Hope you've enjoyed today's class. Have a great rest of your day, and we will see you next time. Goodbye, everyone.